So this is problem 31 in your book. And I find this one an interesting one because in this case, we're not allocating costs, we're allocating revenue. And but it's a kind of scenario that would often show up in real life, actually. In this example, let's say we're Dell Computers or some company like that. It's Magic Systems. But the idea is that they've got a PC tower, a monitor, and a printer. Now, it could be a retailer like Best Buy, I suppose. But the idea is that we've got three different products. And the PC, we typically sell for $1,150, and it costs us $375. We sell the monitor for $250, and it costs us $200. So we're not making a lot of money on the monitors. The laser printer, $600 that we sell it to the customer for, and it costs us $225. So we've got pretty good markups on the tower and the printer, but not a lot of markup on the monitor. But if you add up the three together, like the $1,150, the $250, and the $600, that adds up to $2,000. So a customer comes in and says, I want all three of these things. And if they purchase them separately, it would cost them $2,000. But instead, package deal, buy it as a bundle, we'll sell it to you for $1,500. So the customer gets a deal, and we get to sell all three things at the same time, rather than some customers only buying one or maybe two of the three. So in effect, as a customer, I'm coming in thinking, well, I'm going to buy a computer and a monitor. Hey, I can get a laser printer for only $100 extra, right? So, okay, that's good. So I might do that. And it might actually incentivize the customer to come in and buy the computer as well, because otherwise they might go to Walmart and buy the computer for $1,000 instead of the $1,150 that we're charging. So, but because of this special deal, we're actually selling more monitors, we're selling more computers, as well as printers. So this seems like a pretty good idea. But how do we split the revenue between the three divisions? We have a PC division, we have a monitor division, we have a laser printer division. And if you've got three managers who are in charge of each of those divisions, they're going to fight over the revenue, right? So do we do like an incremental approach where you say, well, all 1,150 goes to the PC division, all 250 goes to the monitor division, and only what's left, $100, goes to the laser printer division, right? Because basically we're throwing in the laser printer almost for free. So the laser printer division only gets $100 revenue. But if they've got $225 in costs, they're going to be kind of upset with that approach. So that's called the incremental approach. And if you look at problem 29 or something, I think that's the one, it's a really good example of this incremental approach. And they actually also use what's called a Shapley model, where you alternate who goes first. So in other words, in the example I just gave, the PC gets all of the money, the monitor gets all of their money, and whatever's left goes to the printer. Well, what if I started with printer first, right? So what if printer gets all of the money? What if monitor gets all of the money? And then whatever's left goes to the PC division, and they lose out on the $500, in terms of the contribution savings, the customer savings. So that's called the incremental model. And Shapley comes along and says, yeah, let's split the difference. Let's do all the different incremental models and come up with something halfway in between. And that's his model. And that's another approach. And so you can do that example. But instead, let's do this one. So this one, they say, let's do it let's allocate it based on, say, revenue, right? So what's the normal revenue? What's the percentage of each? And we'll get the same percentage of the revenue uh, for each of our different product lines. So I've set up a little spreadsheet here. In advance. So I'm just going to put that off to the side. Move this over. And just in case, somebody has a comment that I'll miss, I'll put that over there as well. One of these days, I've got to get myself a second monitor rather than trying to put everything on one monitor. But maybe I can't afford the $250. But in any case, this should work. So you get to see the question. All right. And so this is how I would approach the solution. This is my approach. So over here, we've got, they say on the first part one, they say, what if we split the revenue between the three divisions based on what the normal revenue would be, right? So the normal revenue would be $2,000. Instead, let's figure out what the percentage would be. So what's 11, so this would be equal to 1150 divided by 2,000, right? So in other words, 1150 is 57.5% of the 2,000. So if people paid full suggested retail price, they would pay 2,000, of which 1150 would go to the PC division. So that's 57% of the total. So what's 57.5% of the total of the 1,500 that the customer actually is paying? So they're going to get 862.5. And we can do the same thing for the others, of course. So it's going to be, 250 as a percentage of the 2,000 would be 12.5%. And what about the printer? I guess that works out to 600 divided by 2,000, or the printer division gets 30%, or $450 out of the 1,500. Now, I'm going to move this over a little bit. And I think I've got this. Yeah. So what would be the originally, right? What would be my profit? It'd be 1150 minus the 375, or $775, right? So that's what the PC division would receive as gross profit on their normal sales. Now they're only going to get 862. Their costs are still 375, right? So, I guess I didn't pull it over far enough. So instead of making 775, they're now making 487.50. What about the monitor division? Instead of making $50 on each one, right? Because they were selling them for $250, making them for $200. So they were making $50. Now they're losing $12.50 on each one. And the printer, they were making $375, now they're making $225. Now, so effectively what this means is that everybody shares equally in terms of the percentage loss of revenue, but it hurts the monitor division a lot more because they were making a very small profit margin to begin with. So what if we split the revenue instead based on the relative amount of the cost of each item? I mean, it's as good a way as any. So if you added up the three components, it adds up to a total of $800 in cost, right? So, and which makes sense. We're selling it for $1,500. We've got $800 in costs. So the company makes $700 instead of $1,200 on every bundle. But we're hoping that we're going to sell a lot more bundles, and therefore we're going to do fine, is the idea. But if we split the revenue between the three divisions based on the relative cost of each item instead of the relative revenue of each item, what do we get? Well, we're going to get 375 as a percentage of 800, or 46.88%. And we're going to get, for the monitor, because the monitor, relatively speaking, is more expensive because they have a lower profit margin. They're going to get 25% of the revenue because they've got 25% of the cost. And the printer division, they're just going to get a little bit more than 25%, but not a lot more, 29%, 28%. And all of a sudden, if I'm the monitor division manager, I'm saying, cool, let's go with this approach, right? Because originally I was making $50 on each. The first idea made me lose $12.50. Now I'm making $175 on each. Let's go with this bundling approach. I love it, right? So again, it's arbitrary. It's going to affect people's behaviors, the way they think, if their performance evaluation is based on these numbers. They also suggest, well, what if, hey, there's 3 items in the bundle? Why not just split the revenue 500, 500, 500, right? Or mathematically, if you wanted to actually do it properly, you'd say, well, what's 1 as a percentage of 3? What's 1 monitor as a percentage of 3 items in total? What's, whoops, sorry. What's 1 printer as a percentage of a total of 3 items? And sure enough, it's 500, 500, 500. I mean, you could have done that in your head. And now all of a sudden, boy, if I'm the monitor division, I'm really liking this approach because now my profit goes sky high. But I think you can very quickly determine that this is kind of a dumb idea because, the PC is worth so much different than a monitor, and a monitor is very different than a printer. You really shouldn't be treating them equally. So, I mean, theoretically, this is a model that one could use, but you're never going to do it. But you could choose either of these, and I think defend them reasonably well. But the key here, I think, to think about is 1, can you physically do the calculations? Yes, that's important. Understand what we mean by choosing the allocation base and applying it accurately and correctly. And then the second thing is to think about why are we doing it and what are the consequences of doing it. And yes, I need to identify revenues for each department, and I need to allocate that revenue of this bundle between departments. So that needs to be done. But then the question arises is whether or not we should be evaluating people's performance if a significant input into that measure is arbitrary. And so am I actually evaluating the performance of these managers based on an arbitrarily defined dollar value for these bundles. Now, if the sales of the bundles is really, really minor, sure, throw it in. But if this is a significant proportion, maybe you should be evaluating performance on cost control or on just on sales of individual items in total. Are you matching demand with supply? There could be a variety, employee turnover. There could be a variety of measures of performance that a manager has influence over, as opposed to head office's decision on how to arbitrarily allocate the sales revenue of a bundle. So what do you think? Hopefully that makes sense.